Hey friends, family, students from around the world. This is Jeremy Alexander Newsom with Real Life Trading. Thank you so much for watching this video. You might be watching this video from YouTube, from Twitter, from Facebook, from one of my blogs. But regardless, if you made it to www.reallifetrading.com and you clicked on this little guy right here, think you're all right, grow and fine-tune your skills, the meat of trading and technical analysis. Well, these four classes really cover what is and what comprises technical analysis specifically, and goes into the core understanding of what you need to know to understand how to trade quickly, how to trade fast, which pretty much mean the same thing, and how to, of course, trade profitably and be consistent and disciplined. Focus on the easy things first, and I assure you, I can teach you how to trade quicker than anyone else out there, because one of my specialties is boiling all the information of the stock market down into some very small, bite-sized chunks of real life applicable information. So what I'm going to first start off with is Dow Theory. Now, Dow Theory was developed by a gentleman named Charles Dow, and you might have heard of him before, the Dow Jones Industrial Average. Well, Dow and Mr. Jones were partners a long time ago, and he came up with a theory. Now, he never called his work a theory, but it was first published and put together by a gentleman by the name of William Hamilton. And Dow came up with 6 what are often referred to as tenets or principles regarding his theory. And what I'm going to do is, in this particular section, is really outline the most basic and the ones that, in my opinion, mean the most. So, number 1 tenet of Dow Theory is that the price discounts everything. Now, what does that mean exactly? Well, the price discounts everything simply means that candlesticks are very, very important. Candlesticks can rule out indicators of every kind, because indicators, ladies and gentlemen, are actually built from price data. They're built off of many variations of the open, high, low, and close and volume on a particular stock. So the simple fact is, using data on the chart that currently exists is really the most important piece of the puzzle in understanding the candlesticks. So the next class that we get into is really going to dive down into specific candlesticks, the types, the locations, different kinds, different forms, different variations, why they're created, how they're created, and then we're going to hop into some chart patterns as well, understanding what patterns form from candlesticks. And then we're going to talk about one of the most important and essential aspects of technical analysis that baffles so many people is sentiment, trapping, and gaps. So talking about Dow Theory, the number 1, again, most important thing is the price discounts everything. So what he's saying, ladies and gentlemen, is if you already know information about a stock, it's likely already factored into the price of the stock. So for example, let's take this particular company. You know what? Let's hop over to Apple. We'll hop over to Apple really quick. And we will look at present day Apple, which is 2014 September, October area. And back in here, when the stock started making some really, really good moves and had some really phenomenal gaps, there were a lot of people talking about the iPhone 6 was coming out. Well, ladies and gentlemen, here's my question to you. Back here, did we already know the iPhone 6 was going to be a thing? And the answer is yes. Now, did the iPhone 6 cause the stock to go up? Maybe it did, maybe it didn't. But what I can say for sure is the price data dictated that something was going to be happening very soon on the stock. So again, this is a chart pattern. We're going to be talking about this more later, but you have higher lows and you have lower highs. So when the stock gaps, gap action, and the gap broke through this short-term resistance area, anyone who went short in this area was, of course, losing money. So anyone who went bearish or is trying to make money as the stock goes down, they began to lose money. So the gap, which we're going to be talking about in a lot more detail in a few classes, The stock gapped up in price due to earnings. Earnings outlook was quite good on Apple, and based on this particular chart pattern, ladies and gentlemen, at that moment in time, based on this gap and based on the location of the gap, I was very, very, very bullish on Apple. Now, granted, we did have a resistance right here in the green line, which was approximately 82.26. Now, once we closed above that resistance level with this beautiful candle, I was very confidently bullish at that point. So I mentioned, hey, we can either go bullish on Apple or wait for a pullback. So as we're zooming in, the question becomes, ladies and gentlemen, is this a pullback? Okay, so here's your resistance, stock pulls back and then bounces. And the answer is yes, that was a pullback. Now, in regards to the exact candle themselves, did we know that stock was going to run and continue bullish? And the answer is no, not for 100% certainty. However, we could understand and look at the price and simply say, all right, well, we're in a chart pattern. We gapped. We're making higher highs and higher lows. The likelihood of it continuing that direction is pretty good. So in which case, we didn't have to do any fundamental data. We didn't have to do any analysis of the cash flow or the balance sheet or the sales policy or the earnings or anything of that nature. We could just truly come in here and look at this particular price graph of Apple. And realistically, one of the real life trades I set up in our live class was entering here and placing a stop there. As good as that sounds, that really was the overall entry. And I'll talk a little bit more about indicators in the third section, because I do want you guys to get a very good grasp on technicals, candles, gaps, and sentiment before we look into any indicators, so that you can understand the why behind the indicator's creation. So anyway, that was the entry on Apple. And you can see that we did not get stopped out and the trade continued quite nicely. And currently I am still in shares, 100 shares of Apple, lowering my dollar cost average by doing something called covered calls, which of course I'll be teaching you guys more about as well in the near future. So that's one of the most important theories and tenets that Dow proposed, was the price discount to everything. Another second very important one is, and I'm going to leave out only one, and I'll mention it very quickly. But the second one is that stocks move in 3 levels of a trend. There are 3 levels. There is a primary level, there's an intermediate level, and there's a secondary level. Primary levels, ladies and gentlemen, last for about a year or more. So if we looked at Apple from July 2013 to now, what would you say would be the primary trend? Actually, go ahead. What would you say, since I have some live students in class now? All right, Ashley, I have Teresa, Valerie, George, Timothy. All right, thank you so much. So the majority of you are saying bullish. That is correct. How do we know? Let's simply look at the price action. Are we making higher highs and higher lows? Are we going up, or are we doing nothing at all? So the answer is obviously we're going up. We're making higher highs and higher lows. It's quite simple to determine the primary trend. Just look at the long chart and really see what's happening. I mean, if you looked at even further on Apple, you could still stipulate primary trend. Yeah, primary trend is still bullish. We're still going up. We've been making higher highs and higher lows. Now, primary trend lasts for a year or more. The intermediate trend usually lasts for a few weeks to a few months. So the intermediate trend on Apple at the present day is actually a little bit sideways. So if we come in here and we draw a horizontal line, which is quite easy. As you guys know, I'm using TradingView, which is a charting software that's very, very user-friendly and very easy to use. I do suggest you guys signing up for it if you get the opportunity to do so. Here's an example of the intermediate trend. So again, we have to ask ourselves the question, what has the stock been doing the last few weeks to months? Now, think about this one for a moment and just look at the stock and say, in a very simplistic question, what has it been doing the last few weeks or months? And if you're thinking, well, not much at all, I would agree with you. It hasn't really been doing much at all. It's been kind of going sideways. And so if you looked at July to present day, you'll see that if you bought in July and held until present day, which is October the 6th, you literally would have break even, 0 for 0. You're not making any money, which means that this thing is trading insanely sideways on the intermediate level. So that's good to know. So think, for example, primary trends, let's draw a P in here, would be up. Intermediate trend, which is the last few weeks to months, is sideways. What about the minor trend? The minor trend, ladies and gentlemen, is the last few days to weeks. So we're looking at, again, 2 or 3 days to 2 or 3 weeks, and just kind of get an idea of what's going on. Well, if you're probably saying to yourself, it looks a little sideways there as well. Drinking some of my water. That is the correct answer, in my opinion. Apple in that situation, the last few days, is going pretty sideways. Now, you can see there's a big black candle here. There's some white candles here, big black candles, white candles. So there's a potential that we could go bullish. But at the moment, on the minor level trend as well, we are going sideways. Now, my real question to you, ladies and gentlemen, is what happens if Apple starts doing this? Then what would be the primary trend? Would the primary trend be the same, ladies and gentlemen? And the answer is yes. The primary trend would still be bullish. Okay, awesome. So what would the intermediate trend be at that point if we continue to make higher highs and higher lows and we really, really broke strongly out of this resistance? Well, the intermediate trend would go from sideways to bullish. What about the minor trend? As you guys can kind of see on my chart, I drew there the orange line. What would the minor level trend do? It would also, at that point, be going bullish, making higher highs and higher lows. So the strongest and the best trades possible, the most profitable trades and the ones that offer the best risk to reward are the ones when all 3 levels of the trend move in the same direction. Let's try one more. Let's try Facebook. And I'll love Mr. Allen to answer this one for me. So Facebook, again, looking at nothing other than just pure candles. Remember, the price discounts everything. What is the primary trend on Facebook? Primary trend, what is it doing? Well, primary trend is going up. Yeah, pretty simple. It's going higher. Now, is there any good resistance that we've noticed? Well, here's some resistance right here. So we have a resistance point there, and we have a support right there, and very, very recently right about there. Okay, so primary trend then is bullish. Awesome. I would agree with you all 100%. What about the intermediate term? The intermediate trend. What is the intermediate trend doing? So as you guys can see, you can move around the chart with your mouse. TradingView is quite user-friendly. Web-based charting software, very, very useful. The intermediate trend. Take a few stabs at it for me. Intermediate trend. What's the intermediate trend doing? Okay, most of you are writing in, and I could semi-agree with this one, bullish to sideways. You can see that it's not very strong. So again, if we look back in July and just draw a straight line, we haven't really progressed that much. As a matter of fact, we've done this, we've done this, we've done this, we've done this. But are we making higher lows and higher highs? Just a very simple question, yes or no? And the answer is yes. So if you said we're more bullish than sideways, I could easily get behind that, okay? More bullish than sideways. I would agree with you, right? We are making higher highs and higher lows, but we're not doing it with gusto, if you will. So what about the minor level trend? That's interesting. The minor level trend is a little bit tough. With this big black candle, and again, we'll be talking more about candles very soon, there's a little bit more bearish sentiment here. But with this white candle and this particular chart pattern, we're dealing with a little bit of bullishness. So if you say, I'm a little mixed on the minor level, and I could totally appreciate that. So primary would be bullish. We've already discussed that. Intermediate would be okay bullish. Notice my arrow's a little different than the primary trend. And minor is totally sideways. I would agree with you if you said that minor is sideways. Now, what does this help us, and how does this help us in regards to what strategies we use in the market? Ladies and gentlemen, one of the most common questions I get all the time is, how do I know which strategy to use? There's so many strategies out there, and that is the truth. There are literally tens of thousands of strategies. How do you know which one to choose? Well, boys and girls, the strategy is not what's important. The direction of the trade is what's important. You have to be able to understand the direction before you know what strategy to implement. It's just kind of like saying, all right, I want to go on a family vacation. And you gather up all of your family, you hop in the car, and you start driving. So your strategy is to go on a vacation. You guys are super excited about it, okay? But then when you turn to your spouse and say, where are we going? And you have no idea, then the vacation will be much less cool, okay? That's because you don't know the direction. You don't know where you're going. If you're going and you say, honey, we're going south. Okay, that gives her a little bit more of an idea of where you're going. But if you say, honey, we're going to Disney World. God rest your souls. Disney World. Oh, man. Oh, man, with kids. One of my least favorite places. I know that sounds terrible, but before I go off on any tangents, Disney World and myself just don't get along. Anyway, aside the point. If you can come up with a specific direction for you and your family, and you say, hey, this is where we're going, then you have a strategy behind it. If you're going to Disney World, you'll probably pack up on sunscreen, a lot of water bottles. You'll break out your extra credit card. You'll be ready to go to Disney World. But if you just hop in this van and you have no idea where you're going, it changes things. So direction is always the key aspect in trading. When you log onto a chart, ask and find out which direction is this going. The direction gives you the capabilities of knowing what strategy this is going to do or what strategy you should take. So for example, when Facebook gapped up right here, when it did this gap action, there was a resistance right here. And as you guys can see, old resistance becomes new support. Well, I knew based on the gap that it was a bullish gap that would likely retest. I knew that it was a primary trend bullish. I knew that the intermediate trend was bullish. But once I saw this candle, I said the minor trend is probably bearish for a little bit. So the minor trend pulls back into the primary and intermediate trends, and you begin to bounce. Are there any strategies that you could have implemented once you understood the direction? The answer is, of course, you could. Yeah, you could have done bull put spreads. You could have done put sales. You could have bought directional calls. You could have bought the stock and started doing covered calls. You could have day traded it. You could have done debit spreads, synthetic longs. I mean, there's so many strategies out there. It's unreal. Bottom line, did you get the direction correct on Facebook? Does that help? If it doesn't, or you need any more clarification, please feel free to email me at any time. Number 3 is that the market has 3 phases. I love that one. I'll get back to that one in just one moment. Number 4 is that the averages must confirm each other. This is the Dow Jones Transportation and the Dow Jones Industrial. I really don't talk much about this one because this is a much bigger viewpoint, bigger trading aspect in regards to large cycles. I'll obviously bring it up much more in the live trading room, which is called the trading floor. If you guys ever want to bring that up in that class, I'm happy to discuss it with you there. But it's realistically the Dow Jones Transportation Index and the Dow Jones Industrial Index should be moving in the same direction. If they don't, the averages in the market itself and the momentum is a little bit suspect. The next tenet, one of the most important ones, is that volume must confirm the trend. Volume must confirm the trend. That's a huge one. Huge. So volume must confirm the trend. I mean, bottom line, what you're looking for is you want volume to increase in the direction of the trend. That's pretty simple and self-explanatory. So let me just kind of, get simplistic for you and get real, if you will. Ladies and gentlemen, when the stocks are going higher right here, did the volume increase, yes or no? And the answer is yes. What about right here? Nice big white candle. Did the volume increase? Yes or no? And the answer is yes. The volume started increasing as we continued higher. So the volume increasing as we continue bullish is actually a good thing. So that helps us. And right here, when the stock was going down and kind of congesting and trading sideways, the volume declined. So volume must confirm the trend. If the trend is bearish, aka right here, you want the volume to increase, which it did. All right. When the stock is going up, you want the volume to increase, which it did. So you always want the volume to increase, regardless if you're going up or down. You want the volume to go up, and volume is a key factor. Now, some of you are asking what makes the red bars and what makes the green bars. It's actually quite simple. This day right here was a very, very big up day for Facebook, but you have a red volume bar. The volume bar color is purely indicated on and depicted by the close relative to the open of that candle. So if the close of the candle is lower than the open, the volume bar will be red. That's really about it. If it's green, that means that the stock closed above the open of the prior day. That's really about it. Number 5, that was volume must confirm the trend. Number 6 is a trend is assumed to be in effect until given definite signals of a reversal. What that means, truly and simply, ladies and gentlemen, is do not try to be the hero. Don't try to be the woman or the gentleman that tries to pick the very, very top of the market. Okay? What I mean by that is truly, if you're looking at this particular phase of Facebook, there were a lot of people out there who said that this is the very, very top of Facebook. It's never going any higher. Well, it did, number one. And bottom line, you could have made some money as the stock went down here. This is absolutely true. We'll obviously talk a little bit more about this in the mastery section because I want to make sure that you understand the general market principles before you start taking counter trend trades, because at the moment, the market's bullish. So any bearish trades are going to be counter trend. So what I'm trying to say is don't be the hero who tries to buy puts or go short right there. Now, it obviously worked, but you would have much, much rather have just gone bearish here and taken some profit there. And that was really about all you did. And then you began to hop in bullish and let the trade continue because the market will remain irrational much longer than you can remain solvent. So don't worry, ladies and gentlemen, about picking the very, very bottom. Do not worry about picking the very, very top. Let the trades confirm. Let the chart patterns and the candlesticks and the volume and yes, a little bit of the indicators help you out in understanding that where the top might form, where the bottom could form, but what will help you in many, many more cases, often than not, is something called the 3 phases of the market, which are my favorite. The 3 phases of the market are accumulation, public participation, and distribution. Accumulation is oftentimes when stocks appear a little bit more bearish than bullish. The news on them is kind of clouded, kind of hazy. Oftentimes there's not a lot of news at all. If it is, it's kind of bearish a little bit, and volume is usually slightly low. Accumulation happens in the bottom of a trend. So accumulation oftentimes looks something like this. Okay, and I'll draw this for us right here. So the green line is the accumulation phase. The green line occurs at the bottom, and these are often characterized by chart patterns like double bottoms, triple bottoms, symmetrical triangles, ascending and descending triangles, line bottom patterns, quadruple bottom, all kinds of different chart patterns. This is where the informed investors, aka you, ladies and gentlemen, will begin to buy some of your positions because, as you might know already, this is a double bottom pattern, and double bottom patterns reveal an accumulation phase. So you would have bought at the break of the neckline, which you'll be learning about more in the upcoming classes. But in this particular situation, what happens is you go from an accumulation phase to a public participation phase. The public participation phase is a fun place to make money. This is where most investors start touting their abilities as being an awesome stock picker. This is when the news kind of start picking it up a little bit and start throwing some news stories out. But this is really when the market gains its legs or gains its strength. This is when things are moving. This is the really, really exciting part of the trade. This is where the money is made. So you'll notice that the stock goes higher. Everyone's enthusiastic. Everyone's enthused about the trade. You have a little bit of a rest right here, which is often called a flag pattern. We'll be talking about that again soon. The stock rests and it continues higher and higher and higher. What do you guys think happens in the red? Well, in the red, ladies and gentlemen, the red is called the distribution phase. And the distribution phase is where people sell. Who sells? Well, people who bought down in green or maybe somewhere in orange. They sell there to make a profit. So as many of you know, the distribution phase, all right, there'll be a little bit of a support line right there, a little bit of a resistance, again, perfect scenario, and it will trade sideways, creating another chart pattern, often, either a channel or a head and shoulders or a triple top, all chart patterns I'll be talking about in a few upcoming classes. So a pattern of some kind will form. This is usually semi-boring. Stock goes sideways, doesn't really do anything for usually a few months, a few weeks at the lowest, but oftentimes a year or more. And it just kind of hangs out, doesn't really do much, and it trades sideways. In which, of course, you can make money in this trade, but your strategies will change a little bit. Why? Why will your strategies change? Because the direction of the market is changing a little bit. In red, okay, in the distribution phase, yes, you might still be in a primary bullish trend, but your intermediate and your minor levels are beginning to break down to sideways. And once that happens, you do usually switch your strategies just a little bit. So, ladies and gentlemen, what happens if this red line, which in this situation will be a support line, what happens if it breaks bearish? And the answer is a bearish public participation phase takes over. And then here comes the cool part. People begin to buy their positions and an accumulation pattern begins to form. It literally just switches sides. So the people who sell at the top, they begin to buy to close at the bottom, right? They begin to exit their positions when they were at short, taking their profit, and or they begin to buy low, sell high because the stock has just sold off. So on Facebook alone, we can see how this kind of works out. Here's an accumulation phase. Here's a public participation phase. Here's a distribution phase. Here's a small bearish public participation phase. Here's a small accumulation phase, public participation, distribution. And then what happens to that distribution phase? That distribution phase actually breaks up bullish, which in that scenario would lead to a bullish public participation phase, which was a really, really nice 10% move or so on the stock. Then you get into a bearish distribution, then you get into a bearish public participation. So in which phase of the market was Facebook right here back in April, May of 2015? And the answer is accumulation. This is when people began to buy more shares. This is when you had a chart pattern, looked like either a symmetrical triangle or descending triangle, depending on how you drew it. But that's when you had wild swings in the stock. You had big candles. They had a lot of volume that began tapering off. That's when people were bearish on Facebook. A lot of bears were out there saying Facebook's business model was overrated, that their mobile device wasn't going to work, and all that jazz. Had to get some more water. So once the accumulation phase broke out, what phase would that be called right there, ladies and gentlemen? And that would be called the public participation. Public participation, there's a little dip in the public participation as we drew. Here it continues, and you get a little bit of a distribution phase. And truthfully, I believe we're in a big distribution phase still currently on Facebook. I mean, it really depends on how you draw it. You could say, hey, we're, you know what, Jeremy, this is an accumulation phase, and this is still a big public participation phase. I could get behind that. I could say it's pretty boring at the moment, but I do know a lot of real life traders who are making good money doing, owning shares and just selling covered calls every 2 or 3 weeks. So at the moment, they're all doing pretty happy. Let's go look at Home Depot. Home Depot is a very, very good example of this. And I'm going to zoom out to a weekly chart. And I want each and every one of you to tell me, based on this, what phase of the market was that right there on Home Depot. Yes, I agree with you. A lot of you are writing in that would be a distribution phase. That's absolutely correct. So in that distribution phase, ladies and gentlemen, could we have understood one pretty simple suggestion? To wait a little bit longer before something happens. In which case you're doing non-directional trading, or you're just being in cash and you're waiting for Home Depot to do something. and or again, you're doing some type of option selling strategy, which we'll be teaching you in the near future. So based on the fact that, hey, here's an accumulation phase, here's a public participation phase, and here's a distribution phase, what phase of the market would Home Depot be in right now? Right now. And the answer is some form of public participation phase. So if you were looking for a direction, could you take this phase of the market and really begin to apply it to a strategy? And I think the answer is absolutely. If you understand that you're in a public participation bullish phase, you're probably looking for some type of bullish strategy, like buying stock and or buying call options. Those of you who aren't familiar with call options, it's okay. We'll learn more about them later. But it gives you the insight and the ability to know and understand the direction that you want to go. And from there, ladies and gentlemen, based on simply the Dow Theoristic approach of the market, you can really understand a little bit better what direction it's going, the where, the why, the when. And then once you get that, you can keep it as simple as you want. You can keep it very simple. I know plenty of students who all they do is buy stock. That's it. They buy stock, nothing more, nothing less. I know a lot of students who buy options, nothing more, nothing less. I have one guy I know, his name is Paul. All he does is trade bearish. That's it. That's all he does. Why? He's a perma bear. That's fine. No big deal. He's always bearish in the market. I can appreciate that. But as his specialty, right? When the market does go down or take a quick nosedive, he gets in bearish and makes a little bit of money, then gets out. It's his specialty. It's something he works on. So remember, the market rewards the specialist, ladies and gentlemen. Specialize in something, regardless of how easy it is, and the market can pay you. If you have any questions about this session, about this class, please feel free to reach out to us at any time. My email address personally is jeremy@reallifetrading.com. My Twitter handle, of course, @NewsomeNuggets. You can email the entire team of Real Life Trading at support@reallifetrading.com. But ladies and gentlemen, we're here to help you. We're here to enrich your life and enrich the world, one person at a time. Please help us achieve that mission. If you think of someone that you might know who could benefit from this or enjoy this free information, send them the email, send them the link, send them the video, get them to the website, refer them, whatever you can do. Help us help them enrich their lives. Ladies and gentlemen, thank you so much for watching. I truly appreciate it. And remember, love life, live life, trade it. Welcome to Real Life Trading.